That'll probably reverse as we see the price, the price of oil flow through to the inflation readings. But will higher prices, will that start to weigh into our spending habits? And that's what we're going to be paying attention to down the road.
So big picture, did you look at this column and kind of feel like, okay, low fire, low higher, more of the same, basically?
I think more of the same. I think it tempers expectations for the past 3 months. We kind of shifted from what was considered a stabilizing labor market. We saw some weakness. We saw that unemployment rate tick up, and then it held steady for a while. And then we started to see those 3 months of strong gains. I think this just shows, okay, it's still kind of moderate, temperate, maybe low fire, low higher. It's probably still the best way to describe it, but it's not necessarily going gangbusters right now. So I think we got to rein in the enthusiasm a little bit, what we saw from the past few months.
All right, so that's what you thought of the report. What do you think Kevin Warsh makes of the report? What does he think?
I think that he had a sigh of relief because we got this hawkish pivot from the Fed, both in the statement and from comments from Warsh. But I think deep down, I don't think Warsh really wants to have to hike.
Yeah, you say don't get carried away by that hawkish tone.
Yeah.
What did you mean by that, Colin?
So when we look at the FOMC meeting from a few weeks ago, seems like it was a few months ago, there's no shortage of hawkish things that you can pinpoint. The very short statement that has Warsh's hands all over it. Let's say less. That dot plot where we saw 9 officials projecting a hike by the end of the year compared to 0. But I think it's a little bit more moderate than that. That dot plot, I think it could have just been the officials sending a message. We don't know what the outlook for the dot plot is. I don't know if we'll probably get a September one. I don't know if there'll be changes between now and then. But I think some officials are like, let's upgrade the outlook there to kind of send the message that we're serious here. But when you think about that dot plot, it didn't really jive with comments from most Fed officials leading into the meeting. There was really no sense of urgency from really any of the officials that we need to be hiking now. So I think it kind of just been a message. And then when you think about the inflation outlook, we think the worst could be behind us.
You do. Why do you say that?
Mainly due to the drop in oil prices. We're at this point now where we can start to see some negative month-over-month readings, given that the price of oil is now $70 or less when it was over 100 for a couple of months. We can start to see that flow through. We know that core inflation matters, though. So the question will be, well, do we start to see those roll over as well? Or will we see kind of a lagged spillover from companies kind of passing on that increased energy cost down to the consumer? So we'll have to see how that inflation outlook plays out. But I think if we want to rein back in, then maybe it's not as hawkish as what the headlines would suggest. I think today's labor market supports that case. And if anything, our view has been that the Fed can take their time here. They can explore and see how the next few months look, go into the fall, and then decide if they need to act. And I think this supports the case that they can actually be a little bit patient.
Your base case is they stand pat right here?
Our base case is that they stand pat. If we were to put calendar-based guidance on it, we'd say they're on hold through the end of the year. But we acknowledge that the likelihood of a hike has increased. Just a month ago, 2 months ago, we saw those risks as more two-sided. Maybe they'll hike, maybe they'll even cut. The idea of a cut is out the window now. There shouldn't be discussions about cut. The decision now is hike or hold. We're still leaning towards hold. But if we start to see maybe a reversal of what we saw today with the labor market, if we see it actually strengthen next month, if we see those core inflation readings continue to pick up, I think that probably moves the needle for the Fed, but it just supports the case that let's see how the next few months play out.
Let's end here on some investment advice. Sounds like you still favor investment grade bonds. How come, Colin?
We think the yields are pretty good. There's this big question when you look at the non-treasury market, the credit markets, corporate bonds, whether it's investment grade or high yield. You have what we think are attractive yields, but the spreads, the risk premium you earn are very, very low. Despite that, we're okay taking a little risk because we think corporate fundamentals are pretty good. If you look at the economy, it's still growing at or near its 2% trend level. Corporate earnings are really good. I mean, we see that in the stock market, and that flows through to corporate profitability, corporate balance sheet, the ability for corporations to remain current on their debt. So we're comfortable taking some credit risk, both with investment grade and high yield, but we acknowledge that with such low spreads, it doesn't really leave much wiggle room if the economic outlook were to deteriorate a little bit. So be selective, don't go crazy, and maybe don't focus on the lowest rated parts of the market. So with high yield, the triple C's, that's the big risk. But if you focus on double B's and some single B's, we think that outlook, the balance of risk and reward, looks pretty attractive.
What are some, what are some uncommon mistakes you think bond investors could be making here?
I think right now with the outlook of a potential rate hike, not necessarily our base case, but there's a lot of chatter about that right now. So when we hear that, and a lot of investors and consumers hear that, they just hear higher rates. So let me wait. So we see a lot of our clients at Schwab are still kind of parked in short-term investments, cash, money market funds, waiting for yields to rise. And so what we'd say is, well, we don't know if that increase will actually ever come. And if it does, it'll probably be modest. You know, we're not talking about the start of a new rate hiking cycle. It's maybe a hike or two. And if you look at short and intermediate term maturities, the 2-year, for example, you might be able to get close to 4.2%. The Fed would need to hike twice just to get to that level that you could lock in now. So if you're too short, if you're in cash or money market funds, there's an opportunity cost there. And we think there's a little value. We're not saying you have to go crazy and buy long-term bonds right now, but slightly longer on the curve to lock in some what we think are attractive yields.
Colin, always great to see you, especially on set. Thank you, sir.
Thanks for having me.
Coming up, we speak to the CEO of Securitize about that company's public debut. That is next on Market Domination. Time to cover some of today's trending tickers brought to you by SIBO. We'll start here with Palantir. Shares are higher after getting an upgrade from D.A. Davidson. The analyst behind that call is saying that the valuation is the most attractive it's been in a while, especially in relation to other software companies. Stock is extending gains from Wednesday's session when it jumped 7% after unveiling a new AI partnership with NVIDIA focused on government and other security-sensitive customers. Next up, Rivian in the spotlight following stronger than expected delivery data and improving outlook, with investors pointing to rising gas prices as a supporting factor for EV demand. The company also boosting its full-year delivery guidance to 70,000 vehicles, signaling strength in its lineup and early momentum around its lower-cost platform. And lastly, Robinhood announcing some new offerings on its platform, including agentic crypto trading and stock tokens that will be tradable 24 hours a day. The company has been expanding its global reach too, launching Robinhood in Canada for crypto products and just recently receiving its Singapore license to expand there. Well, it's a fruit and foam takeover happening at coffee shops, including big hitters Starbucks and Dutch Bros. Yahoo Finance's Brooke DePalma joins here with more of this. All right, Brooke, so Starbucks traditionally you would think of as a coffee company, but increasingly you say fruit flavors and foam. So explain this and what's driving this?
I mean, have you ever heard of a banana bread latte, Josh?
I sure haven't.
Okay. So let's break this all down. So essentially, banana, raspberry, anything fruit flavored, you name it, even mango, are big hits right now across not only Starbucks, but really across the board when it comes to the coffee market. In fact, Starbucks telling Yahoo Finance exclusively that more than 60% of Starbucks new beverages have featured a fruit flavor since 2024 rather, so since 2 years ago. And it's largely because, Josh, people want to share their drinks on social media. They want them to look colorful. The more color to these drinks, then maybe the more appealing that they'll be to social media users.
Okay, but do they actually taste good?
I mean, they're sweet. They're sweet for sure. And essentially, cold foam is like that frothy topping that you add on to any coffee. And now more and more we're seeing users, customers, integrate fruit flavors into this cold foam. So think like a strawberry cold foam or a raspberry cold foam. I will say, while doing some research for this story, I dabbled in a few, and they're sweet, but they're really good.
How much did the foam set you back?
Okay, so foam, pretty much the standards there will be $1.25 extra, but that means it's a big business for Starbucks, because when you think about that did drive up average ticket sales in the second quarter. About 40%, or rather cold foam sales were up 40% compared to a year ago. And so this is becoming more and more. Maybe people don't necessarily want milk in their coffee, but they're opting for the cold foam. Maybe they don't want flavor in their coffee, but they're saying, hey, if it's integrated on top, then maybe we'll be willing to pay the extra.
I thought one big theme for Brian Niccol was simplifying the menu.
Right.
So fruit flavors and foams. I mean, isn't that the opposite of what we're doing here?
Right. So when he simplified the menu, he quite literally cut items entirely from the menu. And I asked the same question to Starbucks, and what they ultimately told me, Dana Pelicano, who oversees global product experience at Starbucks, what she essentially said was that it's sort of innovating within the products that already exist. So hey, they have the cold foam, they have the strawberry syrup, why not put them together? So ultimately leveraging systems and strategies that already exist. Whether or not this is more complicated for baristas, they probably bake to different.
What about Starbucks rivals? So Dutch Bros, Dunkin', are they doing the same?
Right.
Foams and fruit flavors everywhere?
Foams, fruit flavors everywhere, Josh. Not even at these big names like Dutch Bros and as well as Dunkin', but also up-and-comer Seven Brew that was only originated back in 2017. That's another one to watch in the story. You also have local coffee shops also integrating fruit flavors and cold foam into their drinks as well. This is ultimately a big business. And once again, as people want to take their drinks to social media, also, this is sort of like the return of maybe what we saw in the mid-90s. One coffee expert was telling me that if you remember when the Coolada, remember that drink over at Dunkin'? It still exists today. It's sort of like the return of that want for flavor and fruit. But once again, little sweet here, but it's what customers want yet again. I mean, where it's like, are the 90s back? Maybe some nostalgia happening there too.
What do you think, like in terms of big takeaways, if you're an investor listening to this, right? Is one takeaway, listen, consumers are still willing to spend up if it's for the right product?
Yeah, I think that what one big takeaway that I got from so many different people that I spoke with for this story was that innovation is key in this market right now. You want to make sure that you're staying on top of trends. You want to make sure that you're following what customers customers, and particularly maybe even micro or macro influencers, are doing right now. They're sharing their My Coffee order on social media. They're sharing what they like to get, and they're sharing these Starbucks orders that have a lot of different flavors, a lot of different additions to them, and customizations are key right now that's driving up price. And so for investors out there who are listening, the customization market is huge right now, and customers are looking to make maybe their coffee order in their own way, whether it be add the cold foam or add some fruit flavor. It's what they're gravitating towards right now.
All right, we'll end here since we have you. How about this story? Blackstone-backed Jersey Mike's subs and Cumberland Farms filing for IPOs. Jersey Mike's by seeking a valuation of at least $12 billion. What do you make of it? The IPO window looks to be widening here.
Yeah, I mean, this comes after that robust SpaceX IPO. We had Lime's, the Scooter IPO earlier this week, and now this afternoon we're hearing that Jersey Mike's, the Jersey Shore sandwich chain, is making it to the big guys, making it to the public markets. I don't even, have you ever tried a number 13 Mike's Pie?
I don't know if I have it number 13. I have that Jersey Mike's, but I don't know.
Italian. But anyway, it's getting everyone excited. I mean, this is a company that really in the past few years has hit such a stride over from 2020 to 2025. We've seen cumulative same-store sales growth of about 50%. So this one is really hitting a stride, especially after Blackstone did acquire, or rather take a majority stake in it back in 2024. They also brought in industry veteran Charlie Morrison, who formerly was at Wingstop, to oversee the helm. Prior to that, in April 2025, we actually had the founder who's been with the company since he was 14 years old and started working at Mike's Subs. And then he ultimately acquired the business in the late 1970s at age 17. And then he began franchising it out in 1987. Once again, he was CEO up until 2025. So this is really hitting a stride here. And it's a big moment. It also just overtook Chick-fil-A as the top quick service restaurant this year.
Wow.
So Jersey Mike's having a big moment here and now taking it to the big markets.
All right, thank you, Brooke. Appreciate it. Coming up, we dive into Tesla's latest delivery results. That's next on Market Domination. Securitize is officially trading on the New York Stock Exchange after going public via SPAC. The tokenization platform crossing a major milestone as it continues to expand its institutional platform and deepens relationships with the world's largest asset managers, including BlackRock. Here with more, we got Securitize CEO Carlos Domingo. Carlos, it is good to see you. So I thought, Carlos, maybe start kind of high level for investors listening, for viewers watching, Carlos. What exactly is tokenization? Like, explain that for us, Carlos, in simple terms. And also, what are the broad benefits? You know, is it faster settlement? Is it 24/7 trading? Is it lower costs? Walk us through it, Carlos.
Sure. Thanks for having me. We're here at the floor of the New York Stock Exchange behind our market maker, Citadel. So it's a very exciting day for us going public. And in simple terms, tokenization, just to think of it as an upgrade of the rails that capital markets run on. Today, capital markets run on technology from the 60s, from the 70s, disconnected from each other. That requires a lot of intermediaries. It has, issues with long settlement cycles, as you mentioned, lack of 24/7 trading, a lot of manual operations to do things like paying dividends, etc. So this is like upgrading how the rails of capital markets to a better ledger technology, which is what a blockchain is, to make them more efficient and allow for better fractional ownership, more accessibility, 24/7 trading, instant settlement, etc.
Carlos, what if folks pushed back and they said, okay, Carlos, but you know what? Wall Street works just fine already. I can trade stocks in seconds on my phone. What's really broken in the system? Where's the real friction that demands being addressed?
Well, if you look at what are the two largest trends on equity tradings today, they're basically retail adoption. There's been, constant growth of retail adoption, as well as, offshore demand for U.S. Equities. So, and if you think about those two trends, they're not met by the current market conditions. So last Friday, for instance, in the US here, it was a holiday. And if you were in Japan and you wanted to trade Apple shares, you couldn't. Or today at 4:30, markets are going to close. So liquidity is going to be terrible when somebody wakes up on the other side of the world, or a retail person comes back home from work at 7 p.m. and wants to buy stocks. So that's the friction that we're going to eliminate.
Yeah, so for the average investor, tokenization ultimately means, Carlos, faster trading, more access, lower minimums?
100%. It's going to be more efficient. It's going to have less intermediaries. It's going to make it easier for people to consume, U.S. equities worldwide. And by the way, today we launched our IPO here in the New York Stock Exchange, but at the same time, we put our own shares on chain, and that they are tradable from day one in both traditional markets as well as blockchain markets.
And explain your business model to viewers, Carlos. How do you all make money? Like, if BlackRock wants to tokenize a fund, how do you fit into that?
Well, we are a service provider for a company like BlackRock. We are also their distributor as a broker-dealer, so that's how we make fees. BlackRock uses other service providers, traditional ones, for the non-tokenized version of their funds. So we actually are the service providers for the tokenized version. We obviously have a different, if you want, pricing mechanism, because there are certain things that are very easy for us to do that we don't need to charge for it. So we're probably, a lower cost provider in some aspects. And then we're a distributor, right? So all the AUM that we bring to the products in our platform as a broker-dealer, we charge fees for it.
How much of your industry, Carlos, and your industry's future still depends on regulators?
At this point in time, very little, right? So there are certain things that, regulation can actually improve and eliminate friction. But, today we're managing funds for BlackRock. They're on chain. They are in the US. We don't need to go offshore like other players are doing. We just launched today, our own equity tokenized trading in US soil and available for, global investors. So there's a lot of things that we can do with existing regulations that we don't need anything else. That said, there are certain, improvements that we can have in terms of how things trade, how, like the definition of accredited investor, make it simpler so more people can access, certain types of securities, eliminate certain, trading rules that add friction, etc. But for the most part, this is here to stay and can actually comply with today's regulations.
I'm curious, Carlos, to get your take on how you think the regulatory environment here in the US has changed, if at all, under SEC Chair Paul Atkins.
I think Chair Paul Atkins has done a fantastic job in providing regulatory clarity. For the side of our business of tokenization, he's done, very interesting things like, our broker-dealer can now do custody of tokenized equities, and it was not possible to do it before. Has publicly acknowledged the SEC that, transfer agents like us can actually use, public blockchains as the ledger of record to work for securities. So all these things happen in the last 12 to 18 months, and it's been great for the industry.
Final question, Carlos. I'm just curious, if we're going to put trillions of dollars in stocks and bonds onto the blockchain, what ultimately, Carlos, keeps investors safe from cybersecurity issues, from hacks, from thefts? How much of a threat, how much of a risk is that?
Well, this is the risk as any risk of our technology platform, right? So today, people could hack Nasdaq if they wanted to, and that doesn't happen, right? Because they take the necessary cybersecurity protection. So the same thing will happen when they trade on a different platform like a blockchain to make sure, investor protection is there and the systems are safe and secure. And by the way, tokenized securities have lower risk than, let's say, pure digital assets, that once they're better assets and when they're transferred, they're lost. That's not the same thing for tokenized securities. So they are much safer assets to put on a blockchain.
Carlos, thanks for your time today. Appreciate it.
Sounds good. Thanks for having me.
Well, Tesla's second quarter delivery numbers exceeded estimates, but Wall Street not too impressed, it seems like. Here to discuss is Yahoo Finance's Pras Sumerani. All right, Pras. So put this number in perspective for us. This was this is a big beat. This is 480,000. What changed here?
Yeah, I mean, look, 480,000 versus 398,000 was the sort of the Bloomberg consensus. So that's up 25% from a year ago, 34% sequentially. Here it goes.
That's live television. You can't control that.
I can't control it. People are excited. People are very excited. But yeah, I think a lot of it has to do with the new Model Y, right? So last year at this time, it was still ramping up in the factories. It wasn't fully there yet, so the production numbers were lower, and we saw a lot of Tesla sales across the globe kind of come down because that new Model Y wasn't available. We also had the Elon Musk factor. At that point, he was still part of the government, part of the Doge, was very unpopular there, here in this country and abroad. So that was still kind of in the mix there. A year later, things have probably cooled off a bit, and you're seeing that now in the numbers.
Can we have any kind of line of sight into regionally what was strong, what was relatively weak, Europe, China, US?
So the Tesla doesn't break it out geographically, but we have some data from like auto bodies in Europe and China where they saw registration data was quite strong. In particular, Europe, I want to note here, Tesla alone was up 108% in the month of May to 28,000 sales, and in the first half of the year, up 60% to 120,000 units. So there's some big numbers there, and we also saw that Giga Berlin upped their capacity. They're actually building more, so that's sort of indicative of the fact that there's more demand there, and they're ramping up supply to meet that demand.
So it was good news generally. So why is the stock down today?
Yeah, I think it's more, I was looking at, I thought it was more of a sell the news event. I think Gene Munster at Deepwater Research was talking about that, how that's what that was, and perhaps the whisper number that was out there was much higher than expected. We saw a lot of Wall Street banks were looking at 420, 430, but for some reason the consensus was much lower. And also there's, Munster mentioned the gas price fact that maybe there's people discounting this number because they think that people bought a lot of EVs in this country, maybe or elsewhere, because gas was so expensive, and that led to this maybe a temporary bump in Q2 for Tesla.
You mentioned this, but just come back on it. A year ago, it was all about Musk, and they can't stand the guy, and he's polarizing, and he's wrecked the brand. I mean, does a number like this, does it tell you okay, that's yesterday's news. Maybe it was overblown to begin with. What do you think about that?
I think there's a good mix of a lot of all those things in there. I mean, we had some data when I wrote about this. I interviewed a PR crisis expert on this, and what advice he would give Musk, because there was data out there that showed that people were actually saying, "I'm not going to buy this car because of him." At the time, it was the peak of his involvement with the government, right? So now I think it's a bit. You could say it's a bit overblown, perhaps. Jack Ewing, great writer from the New York Times, did a big piece where he interviewed a lot of people in Europe, and for the most part, what they were saying was, we still don't like Musk, but the thing is, the car is so cheap here compared to other peers, and the technology is so good. So they're basically holding their nose while they buy. So there still is a negative Musk factor here. Like he's always out there kind of spouting off on things, and so people are upset about that. But if push comes to shove and prices are good and the technology is still good, I think I'm still seeing that effect here in the States. People say, I don't know if I want to buy Tesla, and I say to them, look, yeah, Musk is one thing, but the product which I've tested is amazing in terms of the app connectivity. No other company does it better.
I want to switch gears here. We hit Tesla. Let's talk Rivian. Pre-announces Q2 vehicle deliveries, but it sounds like the big news was really the guidance getting raised.
Yeah, I was surprised to see. So first of all, this is all going to be R1, the original expensive vehicle. They did quite well, maybe because they're moving out some older vehicles because they know the new car is coming in. But to bump the guidance up, I think it all has to do with R2. The new vehicle, the mid-size vehicle, the Model Y competitor. Supposedly, a lot of these invites to configure the vehicle are going out, and it seems like they're going to be on schedule to release that car. End this quarter, potentially ramping up into Q3, and it looks like they think they can sell enough and they can move enough quantity to bump up that guidance, and Wall Street's really happy. I mean, look, the stock. I looked at the stock today. Nice move today, but it's still down 8% for the year. It's still a tough stock, but the good news is coming there. And then for them, if they really want to hit true profitability, beyond just gross profit, they need that R2 to sort of scale up and sell a lot. And it seems the reviews are positive, and people are buying them, and it seems like there's some good news there for them.
Yeah, I saw the team at Canaccord weighing in. They told clients, as other OEMs retreat from EV commitments, we believe Rivian has a unique, timely opportunity to push forward. They say, pull ahead of the non-Tesla pack and establish itself as the next American auto icon.
I mean, they are iconic.
Yeah.
They have a name,
And here on Ford, Q2 sales, let's dig into this a bit. Down about 10%. What's the story there?
A lot of that was, they're still working through the discontinuations of cars like the Escape and the Corsair, very popular mid-size crossovers. The F-150 still down 10%. Now, Ford is saying this is not a demand thing. This is a supply thing. We're still ramping up that supply from the aluminum fires that had caused a lot of problems. They're finally getting those aluminum plants in the Novelis plant upstate New York that's coming online. They say that they're going to get these cars out there, and they claim that they beat Silverado. They still beat Silverado in terms of sales. So that's good. Also good. Guess what else?
Bronco. Sound like hot cakes.
Over 10%. Over 10%. Yeah.
I'm telling you, in my town, every other car.
Another double-digit. Yeah. Double-digit quarter for Bronco. So it's a big winner for them, and the Explorer doing well. Even Mustang had a good quarter. So there's a mix of things happening there. Ford says, hey, this is not an issue that's big for us. But then again, it's another quarter of declines. But the F-150 is still that's the big mover. So I think that's
bread and butter.
Yeah.
All right, Price. Lots of auto news. Thank you, buddy. Well, shares of Axon Enterprises jumped over 30% in the last 5 days on reports from CNBC that Immigration and Customs Enforcement are seeking a 5-year, $220 million contract with a taser maker. Yahoo Finance executive editor Brian Sozzi spoke to the company's founder and CEO, Patrick Smith, about how he started the business, is innovating the product, and a whole lot more.
I know this is a wildly different business compared to when we talked last time, but for those not familiar with your story, tell it to us, because you founded this company in 1993. You took a lot of big, bold bets many years ago. Why did you found this company, and how'd you get going?
So I got started in this space. I had two friends who were shot and killed. They weren't particularly close friends, but it was more just guys in my social circle. America's more dangerous than many of us realize. Gun violence is a big problem. And the thing that struck me is this is a technology problem. If we had Captain Kirk's phaser, who would choose to shoot bullets at people anymore? And so I started a journey discovering the taser. It had actually been invented before I was born in the late 1960s. The inventor was the chief scientist on the Apollo moon landing program in the 1960s. I mean, this was like a Marvel movie, right? So I call this guy up when I'm 23, hey, whatever happened to the taser? The first place I ever saw a taser was in a Jean-Claude Van Damme movie, Time Cop, in the mid-'80s. Next thing I know, we're starting in his garage in Tucson. 7 years of miserable failure, bankrupting my parents and their best friends that were funding this thing. Then we turned the corner, took off, was wildly successful, so successful that we got hit with a raft of lawsuits and crazy controversy because we came out of nowhere. And this idea of using electricity to incapacitate people, it turns out that that's kind of scary to a lot of folks. And so that's why we invented the body camera business. It was like, all right, people are worried, like, are police abusing people with the taser? What's it actually do to people? Let's just record it. And we made a big bet in around 2008, not only on body cameras, but also on the cloud, because we realized the only way we could scale body cameras is if every 20-man police department didn't have to set up their own video servers. And in the moment we did that, it was a pretty crazy bet. I mean, our stock was down for about 5 years. I took a company, this weapon company making electric weapons, and was converting it to a software company. So investors thought we'd lost our mind. They're like, when in history has a weapon company become a software company? Our customers didn't want to wear cameras. They thought the cloud was illegal for them to put data in something they didn't fully understand. And luckily, we just stuck with it because it just, sometimes you just got to believe. Like, our customers need to be able to show the world what they do. So we're not imagining what happens in these terrible policing incidents. And then Ferguson, Missouri happened, and the rest is history. That's when the business just really took off.
When you found out that you wanted to go all in on a product called a taser in your early 20s, like, how did you develop that first prototype?
It was crazy. I had no idea like what I was doing. And in some ways, that's a gift as a young entrepreneur, because you don't know what you're not supposed to do. And so again, I discovered this inventor lived in Tucson. This was before the internet. So I was at the ASU Law Library looking through patents. And I'm like, holy smokes, this guy's address is like 90 minutes from here. So I dialed 411. And for some reviewers who may not know what that is, before Google, that's how you got a phone number. And he answered the phone. And I basically just went down and visited him. He was 73 and he was pretty frustrated. He'd been at it already for 20 years, basically started 2 companies. They both went bankrupt. And here I am, this bright-eyed, bushy-tailed 23-year-old. I'm like, hey man, like, let's give it another shot. And he basically said, okay, we'll tell you what, if you pay me some patent royalties and we cut a deal, I will help you make the first taser in my garage. And then once you sort of get up and running, I'm going to go back to retirement. And so that's what it was. I borrowed my parents had a trailer. They used to take the dog shows on the weekend. So I lived in that in a trailer park in Tucson. Every morning I'd show up, knock on Jack's, door. All right, let's go. And we built the first taser in his garage. Like, I'm pretty convinced this guy could have built a nuclear weapon if we had some uranium. Like, it was crazy. We're building it with parts from Ace Hardware, taking things like bicycle tire valves and welding them into metal casings to make propulsion systems. And we made our first prototype in exactly 30 days. I remember that. And then the U.S. government, we made the first prototype to send to the federal government so they could give us a ruling on whether or not it was a firearm, which was the biggest risk to the business. And they responded in 2 weeks. So 45 days from the founding, we built our first prototype and gotten government approval. And now I look at, now I've got like 6,000 employees. Doing that would take a team of 50 people several years. Like, that's the startup magic, right? You just do crazy things because you don't know any better.
And of course, they're not made from Ace Hardware materials anymore.
They're not made from Ace Hardware. That's true. But I do miss making stuff from Ace.
So you have this taser device. I mean, what do you go up to the local police, for instance, and say, Mr. and Mrs. Cop, please put away your gun and buy my taser thing. Here's how it works. How'd you demonstrate
that? That was pretty much it. So we launched as a consumer product and failed because consumers were skeptical. They're like, hey, and we launched it in the Sharper Image. If you remember the Sharper Image,
yes.
A lot of cool little gadgets.
Here's the taser right next to the Sharper Image.
Yeah.
That's cool.
And shockingly, consumers were like, okay, this isn't real. This has got to be something to gimmick. Then we had a second product launch that was a car security thing. We were just struggling to figure out a product that would pay the light bill. And then on the verge of failure, we pivoted into policing and we basically dialed in the product and we had no money to launch it. So it literally was exactly what you said. We hired a former Marine in a Winnebago who went cross country knocking on doors at police departments. Like, hey, let me show you the new taser. And in the early 90s, a taser was used on Rodney King in Los Angeles and it failed twice. That was before I started this company. That was an old taser. And they went to their batons, and obviously the rest is history. So the taser had a horrible name in policing. Nobody believed it worked. And so when we would show up at police departments, we gave this guy a couple $100 bills. And the pitch was like, all right, if you don't believe the taser works, here's $100. Who wants to try it? And then literally we'd hook him up, Nobody got the $100, they would fall down. Like word spread like wildfire. One thing about the police community, they all talk to each other. There's all these communiques they share back and forth. And suddenly, within 12 months, we were cash flow positive. 18 months from the launch of the M26, we went public on the Nasdaq in a massive $10 million money raise. That was our IPO, raised $10 million.
And now you're a $40 billion market cap.
We've come a ways. Yeah.
Tell us, explain to us a little bit from an entrepreneurial standpoint. How did you scale up the business? Because it's not like you could just give someone a former Marine $100 bills and go to every police department. Like, how did you get the business where it needed to be in those early days?
Well, it really was that. It was like I was out personally leading instructor courses. What we learned is in policing, the first thing you got to do is you've got to have an instructor's class so that they know how to use the equipment and that there's a certification process. They will not take anything out on the street without certification. All right. So me and this Marine, he happened to be the former chief instructor of hand-to-hand combat for the U.S. Marine Corps. So he knew about developing lesson plans. And when you're small, you just figure it out, right? So we developed it together. And then 3 of us would go out and we would offer these courses. Now, the buzz began with him going cross-country in this Winnebago, knocking on doors. And then as the buzz picked up, agencies were offering to host classes. And we give classes away for free because we also discovered in policing, if the class is free, some cops will show up just because it helps, with their resume to get more certifications. And most companies charge for certification. So this was like a freebie for any instructor to get another certification on their resume. And it was the grunt work that got us going. There was absolutely zero magic. There's that old, there's no silver bullets, only lead bullets. Yeah. You scratch and claw and fight your way to survival. And then once it took off, then you start hiring people and scaling, with salespeople. And it turns out a lot of instructors in law enforcement will basically work as consultants to train at other agencies. They typically can't work for a company while they're doing work at their own agency. That would be a conflict of interest. But like a Seattle PD officer can be an instructor and go train at other departments. In fact, that's standard in the industry. Most police departments do not want to be trained by a sales guy. They would rather be trained by somebody that they know, okay, you're a professional cop, you're paid to train me, but you don't make any money if I buy or not. I can trust that you're going to give me the real scoop on this.
Was there a moment that you could point to that you knew this company was going to be big?
When Sacramento police bought tasers for every officer, that was a crazy moment. Because we're like, man, the capital of California, and that was about 3 months before our IPO. Mm-hmm. I'd say that was probably the moment. Maybe the one right before that was the first time I ever saw a cop carrying a taser out in the wild. That was in the Salt Lake City airport. When I just looked over and, oh my God, that guy's wearing the thing I make.
Yeah.
Holy cow. This is working.
Rick, I've never seen one of those before. Could you show it again real quick? That is wild. And it just recharges?
Yep. It's got a rechargeable battery. And then this is the magazine. You put 10 rounds in it. This one's unloaded, so I don't, play with a live weapon while I'm on an interview. But yeah, it's what we've basically learned is if we're going to be successful, we never talk about taking a cop's gun away. That would be just unacceptable in America. There's so many guns out there, but this is a new kind of gun, right? This is a gun that doesn't kill people, but it gives you the job of incapacitating them, which is what you want. Like when police use lethal force, they don't use it because it's lethal. They use it because it's reliable. Our problem is we're not as reliable as a gun yet. Now we're getting very close. In fact, when you mentioned what do we not do yet? Today, our biggest limitation is we have this Achilles heel. This may or may not get through heavy clothing. If you're wearing a down jacket, we may or may not be able to get through it. So I'm spending a fair amount of my time in the labs with our engineers, working on a new cartridge system that is designed to penetrate through heavy clothing, which, believe it or not, that's actually pretty easy. Here's the hard part. The same cartridge, if you're wearing a parka, we got to make it through. But if you're naked and we fire it at you, we got to make sure it doesn't end up down in your intestines, causing a serious injury. So we need it to penetrate through clothing and then stop as soon as it punches through the skin. And we got some
Holy
very
shit.
clever designs.
I mean, like that's why I love doing this podcast.
Coming up, OpenAI may offer the U.S. a stake in the business. We discuss that next on Market Domination. OpenAI is reportedly exploring an idea that would have been almost unthinkable just a few years ago. Financial Times reporting that it's considering giving the U.S. government a stake in the company as it looks to navigate a complicated political and regulatory environment ahead of its IPO. For more, we're bringing in now Darian Shirazi, general partner at Gradient. Darian, it's good to see you. So these reports that OpenAI could be proposing here, handing the government this 5% stake in the company, I guess a way to share in sort of the upside and benefits. Talks are preliminary, apparently. What do you make of this, Darian? A good idea, in your opinion?
I think there's a lot of historical precedent for some level of ownership in different times. I mean, after the financial crisis, we saw the U.S. take stakes in a lot of the financial institutions in the country. In this case, I do believe that AI is more of a national security risk, and that we have to be pretty careful about what these models are capable of doing and who they actually has control and utilization of them. I think having a government non-voting stake in it could make sense in certain contexts. I don't really love government intervention in business. I don't think it really makes a lot of sense. But in this case, there might be some kind of national security play, especially if the government is planning on rolling out these models for many different public use cases that we haven't thought of yet.
Sam Lessin, he put it like, smart guy. He put it like this on X. Here's how he framed it, Darren. He said, strategically, Sam says, this makes sense for OpenAI. The only way for an OpenAI to win, Sam says, and generate long-term profit is regulatory capture. So why not invite it, he says. But Sam Lessin says, this is deeply anti-American, anti-freedom, anti-capitalist, and highly dangerous behavior to anyone who actually believes in American values. That's how Sam Lessin is framing it. What do you say to that, Darren?
I think that's a relatively extreme statement to make, but in general, government intervention in business is not necessarily a great thing all the time, although in the past 20 years, we've seen a lot of regulatory capture leading to big companies. If there hadn't been loans and investments into SpaceX and Tesla, those companies probably would have failed entirely. And so there have been a lot of really big outcomes where governments have provided and lent money or invested money. I don't think that the regulatory capture is the only way that OpenAI can make money. That seems like a relatively broad statement to make. More importantly, I think the risks for OpenAI, Anthropic, and others are that the open source models are going to end up being just as good as these closed source models. And so what happens in that context? However, we're seeing reporting also that governments are using open source AI and having just as much success as the closed source models. So I don't know necessarily if regulatory capture is the way that these are going to be generating large amounts of revenue. I think it's more that they want to have customers in all sectors, government and non-government. And it makes sense in some cases to cut in a big customer onto your cap table in the event that you're going to get a big customer contract, which probably is the reason that they're considering this.
Did you see, I don't know, Darren, Palantir CEO Alex Karp on CNBC made a lot of headlines. He kind of talked about how companies have they went all in on the AI hype. They spent massive amounts on the AI tokens. And you know what? They're not seeing the productivity and profit gains to justify those costs. He says it's a worry he's hearing in the enterprise. I'm just curious what you make of that.
I saw the interview. I think it's a fantastic interview. Karp is brilliant, always has been, and he's built an incredible company. I think also the strategy of allowing enterprises to onboard models through their AIP program makes it such that they likely will be one of the big winners out of the AI era. In the case of token productivity, the models that are the closed source models are extremely expensive, and they're so cost prohibitive that actually to get the productivity that you want out of them, you would really have to spend a significant amount of dollars. However, coding agents that are open source can do a lot of, maybe 80% of the coding tasks that are requested. So I think enterprises are going to have to cost optimize which models they use, which is why we're investing in a number of companies that actually are allowing people to cost optimize. M-Dash is one that we invested in that lets you sort of proxy different tasks, different coding agents. But that's just a function of people having to adapt to what this actually is and what it means to hire a coding agent to do work for you, is that you're going to have some coding agents that are open source, that are cheaper, easier, and faster to run. And then for the more complex tasks, you may want to use Fable or one of the frontier models. And so that's something that I think is just really going to come into learning. And Palantir could be a router between all of those different AI models for enterprises. So I would much rather be in Palantir's position right now than in Anthropic or OpenAI's position, where they can sort of be selling to everybody. And on one side, the model vendors, and on the other side, enterprises, rather than having to constantly develop the best new model, which is the game that OpenAI and Anthropic are in right now.
You used to work for Mark Zuckerberg, Darren, so I wanted your take on another report we saw, which got a lot of attention, which is that maybe Zuckerberg is thinking about entering the cloud business, selling excess compute capacity. Does the world have too much compute, Darren? Does it not have enough? What did you make of that headline and what it more broadly might suggest?
I think that we are definitely going to see significant uptick in the amount of compute that we will need. It's already more than we expected. And I actually think that leasing compute makes a lot of sense. Like there's idle time that they're not using GPUs. They can monetize that idle time. The process of training is sort of, they can do multiple training runs and allow that people to use those GPUs when they're not using them for a training run. But inference is where there's going to be just significant in growth, and more inference is actually happening right now. We're going to see inference at the edge, and we're going to see it within data centers, and we're going to need to build out significantly more capacity than we have today. I actually see the leasing as a sign that they realize that they can monetize that excess compute, and we're going to see more and more companies lease compute and build out more capacity. I mean, we're a big investor in Lambda Labs, which is one of the neo clouds in the GPU space, and there's never enough supply. We constantly need more supply of compute because people are demanding more complex intelligence, more help with the tasks they run in their daily lives. And so as models get more complex, you will need more compute and you'll need more complexity of compute.
Darian, so good to have you on the show today. Appreciate it. Thank you.
Yeah, thank you.
Coming up, we have you covered to the closing bell on Wall Street. Don't go anywhere. Stocks ending the holiday shortened week mixed here. The Dow closing above 52,000 for the fourth day in a row. Investors assessing a June jobs report that tempered expectations for the next interest rate move from the Fed. Markets also weighing signs that talks between the U.S. and Iran may be starting to emerge from another rough patch. Meanwhile, chip stocks resuming sell-off mode, weighing down the tech-heavy Nasdaq. These semis starting the third quarter with a two-day skid here. The sell-off comes amid a volatile stretch for these stocks as investors assess the sustainability of AI spending. Let's look now where investors are focusing on the shortened holiday trading week wraps up. Brian Pietrangelo joins me. He's Key Private Bank's Managing Director of Investment Strategy. Brian, it's good to see you. So maybe start with that jobs report we got, Brian. You read through it. What were your big takeaways?
Sure, Josh, a couple things. First and foremost, it was a great indicator to do nothing. And we believe that the Fed will stay pat for the remainder of the year, will not hike, and will not cut. What was interesting to me is that this was the fourth consecutive month in which there were slower growth rates in the new non-farm payrolls That leads us to look at a couple other factors outside of non-farm payrolls, including initial unemployment claims, to get a little bit of a better read. We also think that it's really important to understand of how the Fed looks at this as a potential dual mandate, that Chair Warsh in his new position continues to talk about inflation more than jobs. So we think ultimately it will lead to no cut, but hope that it does not deteriorate further.
What do you think the trajectory of inflation does look like, Brian, from here? I've had some economists on the show think, you know what, the drivers of inflation, you look at oil, it's come in hard, gas prices are down, tariffs, nobody seems to bring them up on the show anymore unless I do. Are you as constructive or no?
We are. We're looking at those four factors, but many of them are temporary. And looking at the Fed's preferred measure is PCE, core inflation, which excludes food and energy. So we've got housing still in there. We've got services, ex-housing, that are still well above the Fed's mandate of 2%. They're even above 3%. So from the perspective, we think inflation will be a slow turn, meaning that we don't think inflation will come down as fast as people believe that it will, and will probably take at least 2 or 3 Fed meetings with the 4 that they have in the remainder of the year to actually gather enough data to make a material call on inflation being better or worse than it is today. So we think that it's going to be a slow go for the inflation turn. By the end of the year, probably won't get much.
So, Brian, if the Fed is standing pat, if they're on hold, we're higher for longer, that means what for the stock market?
So it could be okay right now because earnings continue to look through that, Josh, from a standpoint that earnings have been significantly resilient. So I think the bigger story for the stock market today is earnings than it is inflation. If you think about what we've been through since the pandemic, with inflation being high and continuing to be high for maybe the 5th out of 6 years, the market continues to rally through that. I think it only becomes an issue if it were to increase materially or if the Fed were to take action relative to the jobs market.
You also talk here about what you call the forgotten 493. Walk us through that, Brian.
Sure. So there's the Magnificent Seven term, which many people know of, and then there's the forgotten 493, which is the other 493 of the S&P 500 index. So we have been in a call position for about 2 years now, where we have been de-emphasizing the mega cap space and emphasizing more of the forgotten 493, which are your traditional sectors that might include materials, might include industrials, might include more of an equal balanced weighting of the 500 rather than focusing on the Mag 7. So from our perspective, there's still a lot of value there.
Brian, what do you make of the fact that, like, listen, the Mag 7 has stumbled here, but then you look at what's been working, and it's interesting. It's, you know, it's small caps, it's regional banks, it's industrials. Is that a sign of health to you, Brian? If you're bullish, is that what you want to see, that kind of broadening?
It is. And in fact, we've been overweight mid and small cap versus large cap for over 2 years. And in 2025, it did not work because of the rally of the Mag 7. But we're now seeing it come to fruition in 2026 in the way that our thesis was built out. So we do believe that it's significantly encouraging.
What about the great AI trade and trend, Brian? You know, is that a bubble? You know, you see Micron up, 700% over the past 12 months. Does that make you nervous?
A little bit. We look at about 4 factors when you try to define a bubble, and everyone tries to define it before it happens, but most people only define it after it happens. So when we look at the 4, the first one that we look at is really understanding significant increases in prices, and that has happened in certain parts of the market. But we also look at sentiment. There seems to be an equal voice of those that continue to think it's great and those that think it's significantly at risk. We also look at the valuation of some of those stocks, and we think that's moderate. And then the last piece we look at is really how much you're using leverage in order to build up, like something we might have seen in the 1990s, whereas we don't see the overuse of leverage right now, considering a material bubble right now. We think we're in a good place. Some yellow flags that we had mentioned, but okay right now.
Brian, you say the next big winners may be AI adopters, not AI enablers. What does that mean?
Sure. So if you think about those that are building the technology, many of them in the Magnificent Seven that are creating the technology to be used, and that's the enablers. If you think about the adopters, those that will use the technology. And so we go back in history and look at many different cycles of innovation in the United States and in the globe, and ultimately to look through and think about how the technology may be used 5 or 10 or 12 years from now is really what we think is the greater play on efficiency and productivity for the long term with the broadening out. I mean, think about how many of the 493 stocks can actually use AI versus the 7 or 10 that are creating the AI. And that's where we really think you get the multiplier effect is with the adopters.
Bottom line, Brian, I'll get you out of here on this. What sectors do I want to be overweight here, in your opinion?
So in our opinion, we have some portfolios that are overweight the traditional materials, the traditional industrials, and energy. And many people might say, well, why would you be overweight energy given where oil has gone and where it's likely to go? And the answer to that is our thesis is a longer term secular build out on energy because we think the infrastructure for the overall energy continuum has not been built up to the degree that it needs to. Therefore, it will cause scarcity in a number of areas for which it becomes a good play. In addition to that, we've got some non-oil related energy sources for some companies that we have picks that we think also will be valuable.
Brian, good to have you on the show today. Thank you.
Thanks, Josh.
Coming up, are airfares coming down anytime soon? We'll find out next on Market Domination Overtime. While fuel costs drift downward, travelers should not hold their breath for cheap flights just yet. Here with more, we got Yahoo Finance's Carrie Hannon. All right, Carrie, so jet fuel prices have come down. Why haven't airlines passed those savings on to me, Carrie? What's the holdup?
Well, Josh, it takes a while for these lower costs to kind of move through the system. But to be fair, the main reason is that airlines lost a lot of money in the second quarter because a lot of those flights had already been booked by the time, the fuel costs spiked. And so they're trying to recover some of those costs. So I think that airlines are sort of backing off, according to the analysts I talked to. They're just taking their time as they try to recover some of that before they pass on some lower costs to the consumer.
Do you think, Carrie, part of this too is airlines are just going to keep charging what they think the market will bear? In other words, if we all keep flying, if the demand is there, why do airlines go ahead and lower prices?
You are spot on. I mean, travelers seem to be taking these higher prices in stride. Demand is still quite strong this summer. There's no one backing down from traveling. And so a lot of the analysts I spoke to said that very thing. They said, there is a business case to keep them high because if people are paying it, why worry? But I think we're going to see after Labor Day how that holds, because typically that's when travel demand starts to die down a bit. And if there is a softening in demand, it's possible you might see some fare sales again.
Can we put some numbers on it, Carrie? Like, how much more expensive is your average domestic ticket now versus a year ago?
Yeah, it's significantly higher, about 20% on average higher than it was a year ago. But Josh, this is down from the peak. May was when it really was sky high. So they are still high, but there has been a softening back down.
So having said all that, Carrie, let's say, I'm listening to this, I am going to book a trip, right? Any kind of smart, basic travel tips, Carrie? Okay,
so my favorite thing is have one of those price tracker apps set, right? Where you want to go, when you want to go, what flight it is. And if you have that price tracker, and the major travel sites have them, you have Expedia has them, Google Flights, Hopper, Kayak, set it, and they'll ping you whenever the fare drops. That's a great way to kind of get yourself in the mode to find a good deal. The second thing is it really does still matter when you book. I mean, it's hard to imagine, but it's true. When you book and when you actually fly. So, don't try to book 6 months ahead of time. That's not going to help you. That's going to be expensive. So you need to wait a little bit. And it still pays to apparently book on Tuesdays. I don't know why, but that's what I heard from some of the travel pros I talked to. And also, like, Sunday is the most expensive day to travel. Friday is, you can get some savings flying on Friday. So these sort of nuances fit into the scheme. But the most important thing is try to get a beat on when that price drops and take advantage of it.
All right, Carrie. Thanks. Great to see you. Appreciate it.
You take care.
Well, the Premier Lacrosse League said this week it has raised $100 million in its latest funding round. Yahoo Finance executive editor Brian Sozzi spoke to Paul Rabel, the president and co-founder of the Premier Lacrosse League.
Look, I want to talk in this funding round, but I was telling you off camera, I caught you on Instagram, like still playing around. I mean, you saw Serena this week, 44 years old.
Right.
Could you be going to the Olympics in 2028 and playing?
I would say it's more likely that I could try to make a run like Serena than play in the Olympics. The Olympics are going to be the hardest team in lacrosse history to make. Mm-hmm. But I do think those times have passed.
So you're rolling out, no Olympics.
My body's broken down.
Damn, I'm rooting for you.
I do like getting against the wall, though. It's like, asking a guitarist to stop playing altogether, so we can have catches whenever you want.
What will the Olympics look like for lacrosse?
It'll be the biggest moment in our sport's history. LA 28 is expecting over 4 billion people around the world to watch. So that comes down to programming and positioning, because not all 4 will watch lacrosse, but a lot more than currently do. That's like 40 Super Bowls worth of viewership. And so you'll get top of the funnel fan access, as we talk about it in the business world. And then our job as a league to convert them into fandom of teams and players. And the most recent example I think did quite well is the NHL. And they led into the Olympics with their 4 nations in lieu of their All-Star game. The Olympics featured USA Canada, which was a huge opportunity for the sport, and then we've seen viewership increase since.
Who are some of the stars right now in your sport, and what do endorsement deals look like for them as they go into the Olympics?
Yeah, so the 2 stars I would call out, one on the women's side playing professionally is Charlotte North. She has the largest following of any active professional lacrosse player. Then on the men's side, you have maybe an ensemble cast, is a better way to put it. Trevor Baptiste, Pat Cavanaugh, Brennan O'Neill, Rob Pennell, and then the emerging rookie Joey Spallina. And so I'm sure you asked that question as we look at Serena Williams, or we've talked about Caitlin Clark in the past, is when an athlete can break through and fully cross over, that sometimes is the best sort of business unit in and of itself, speaking in that language of what can grow the PLL.
One of my friends who played, I believe, Division I lacrosse, she knew you were coming on, so she had this question for you. She's like, ask him about the cost to play lacrosse for youth sports.
Yeah.
This next generation travel teams, just the cost of a stick. It is a big investment. Like how can we support that next generation of lacrosse?
Yeah, well, I appreciate her asking that. It's a focus of ours at the PLL and the WLL. I would say lacrosse is a lot like hockey and golf. It's expensive to play, but we don't have to pay for ice time or green fees. And if you look at the World Cup right now, it's a global game because you just need a ball and you can go play on any surface. So there's always going to be a delta between the three aforementioned and sports like soccer, football globally, and basketball. The one in between not mentioned is American football, which is also expensive to play, but they've largely relied on state and professional leagues subsidizing at the youth level to increase participation and access. Because ultimately, that's where sport can penetrate the community and grow globally, is it's egalitarian. So access needs to be critical. If you look at the youth market, it's roughly a $50 billion market right now. It's huge, and the average family is spending over $1,000. In the club space, they can spend up to $25,000.
Wow.
So part of our use of proceeds is to actually, as a league, because we're not a youth lacrosse business, we have that vertical inside of us, but we just need to break even. We think if we can invest to drive costs down, it'll increase participation, and we don't have to turn around to our shareholders and service margin. We just service participation, which means new fandom, and then you can benefit at the professional side.
Do you have any advice to parents who want to get their kids into this sport who don't have $25,000 to spend on this?
Well, rec. I grew up, as my brother did, who's my co-founder and the CEO of the PLL and WLL. We grew up with hand-me-down equipment from our neighbors and played rec lacrosse. And I genuinely think kids should play multiple sports. You have to try something to see if you want to fall in love with it. And then if you fall in love with it, your parents, or by means of AAU programs you grew up in doing car washes to try to finance your trip down to Florida for a national tournament, you figure it out from there. But right now, youth sports is kind of reverse engineering it, where you have to invest to find out if you love after you try.
What was the pitch to an investor, or investors really? Aris is major in private equity, and a Joe Tsai over there at the Brooklyn Nets from Alibaba. What's the pitch for them to invest this amount of money in the league?
Well, it's our growth trends right now. Year over year since we've started, double digits across every business unit growth. So media to sponsorship to tickets to merchandise, and then our youth business from a participatory standpoint. So the growth trends are there from a business standpoint. The vision has to be that we are the tier one property of this discipline. And while there are a lot of emerging sports leagues, many of them are tier 2, 3, 4 properties of their discipline. It's the challenge going back to football around the world, is MLS is not considered the #1 league in the world. The Premier League is in England. So you have to compete for talent. And the reason that's important is this investment opportunity that now Wall Street is putting a premium on has largely to do with scarcity. It means you have the best players in the world, a capped number of teams, one in, one out, which drives demand of ownership and value. And then inside of that, you have live IP, and inside of these.
It's also AI proof, right? You have to actually go see a lacrosse game.
It's AI proof. Sports is AI proof. Because if you and I were to cross train right now, and we were put a clock, one of us is going to win, one of us is going to lose.
Yeah.
And AI is built to kind of like race to the mean, but also perfect our writing. There is imperfection in sport. Someone has to lose, and you have to embrace that. Now, a robot will go to mid-court and hit 100 threes in a row, not hit the rim, it'll go viral. Second time, no one will watch because they know the outcome.
That's true.
And the beautiful thing about sport, it's the best form of unscripted content. Nobody knows the outcome.
I was thinking there's a good parallel with you, I think, with Russell Coutts. He helped co-found Larry Ellison, sell GP League. I talked to him recently. He's selling out teams like crazy.
Yeah.
will you start selling teams? Like what type of valuations do you think they could fetch?
I think CLGP and the Ellison Group did a good job, similarly to the way that we've approached it, although being a team sport slightly different than an individual sport, which is we wanted to build a bunch of value around our teams before we took them to market to sell them. I feel like the more value you can create, and that be from revenue that comes in the door with these teams to viewership to fan data, IP development, they're more likely to pay more for that team, feel more confident in their runway, which then would attract more institutional professional sports investors. Now, to get there, you have to have long-term capital that believes in that wholly owned model, which we still have. But our goal is to get to a place where you have individual owners representing not only our 8 PLL teams and our 4 WL teams, but expansion thereafter, which would mean a home and away model or home and away schedule. And a lot of growth that comes from these owners who I think are force multipliers in their communities.
Lastly, before I let you go, is there one thing that you have learned? I mean, I think I saw you 3 years ago at Cannes when this was still getting off the ground. The one thing you've learned as an investor since then, and any mistakes you've made that you don't see repeating?
It's a good question. I think as an investor, you always have to look at macro trends and their impact 3, 5, 7 years down the road. And so if you think about the business of sports, I think the largest trend is that live sports is the final appointment watching television firewall. And the advertising business last year eclipsed $1 trillion in spend. In sports, it's about $90 billion globally. Last year, teams, American sports teams generated about $8 billion in sponsorship revenue. That was up 20% year over year. But if you take the NFL, they do $7 billion on their own. So there's a lot of value in the advertising space, which is why as an investor you go, where are advertisers going to go? It's going to go live sports and the creator economy. And then you look at the macro trend of women's games, NWSL, WNBA valuations, girls' participation in sports, girls lacrosse being in the Olympics, you make a bet there. So I try to look out into the future. The media rights environment is a $67 billion marketplace this year. It's up 10% year over year, but we all kind of go back and forth and go, how much more can it grow for rights fees for a league or team? So it has to be a diversified approach, and that's arguably why we built our wholly owned model.
Well, good to see you. Good to see this news, and I do hope you have a change of heart to play on the Olympics. I just had to say it. I think you can still do it.
Coming up, our next guest went from Wall Street to running a frozen yogurt franchise. We dive into that next on Asking for a Trend. Hello and welcome to Asking for a Trend. Well, frozen yogurt is having a resurgence, but this time companies are battling it out on who can deliver trend-conscious flavors and toppings. Here with more insight into the froyo landscape is 16 Handles CEO Neil Hirschman. Neil, it's great to see you, especially on set. Start here, Neil. Like I think a lot of people, they may have thought of froyo at one point as maybe sort of like a fad that came and went, but is it making a comeback? Do you see a resurgence?
What I'll say is it's a good time to be in frozen yogurt. I think if you look at same-store sales trends over the years, there's brands that have faded. There's brands that went stale, people got bored of, they had bad locations or bad operators. So there definitely was a decline in shop count. But if you look at 16 Handles, which is a kind of a affordable luxury, a higher-end brand in frozen yogurt, same-store sales over the years have continually increased. So it's not like it's necessarily a cyclical thing. It's a good brand with active ownership and active leadership that's investing in research and development is continuing to succeed. But we've definitely been pushing this narrative that, look, you've got a healthier treat here, that you get this full-on experience that people love bringing their family to. The kids love topping it off. And then the adults, like we sell probably more gummy bears to adults than we do to kids. So it's just a great experience. And because it's better for you and people want the better for you, and they also will invest in good ingredients, which we commit to at 16 Handles, there's definitely a same-store sales lift that we're seeing, probably 20-30% this year, and we had a similar lift last year and the year before.
Do you think part of this too is some of it nostalgia? Like we were talking off camera, and I was saying when I was a kid, this is like a thing my dad would take me to. It was time to get a treat. It was Josh and his sister. He would take us to get the froyo. Is that part of it? Do you think?
I think so. Yeah. I think there's a million elements, but there's definitely the nostalgic element, and now you see people who can afford to spend their own money, who as kids went to frozen yogurt stores with their family, and now they're in college, graduated college, starting their own families, and so they're coming back to what was this fun experience for them and this delicious experience for them. And so there's definitely some element to that. But then there's a lot of reasons why it is a great product, a great industry, and has stood the test of time. We're
always looking for lines of sight into the consumer, Neil. So, you definitely have that. Like, has the consumer looked to you versus like 6 months ago versus 12 months ago? Healthy, resilient? What do you see based on your business?
Yeah, I think people do want the health benefit, but right now, it's summer in the Northeast, and obviously around the country, but the seasonal markets especially really feel the benefit of seasonality. And
I was going to ask you, when you have, right now we got this brutal heat wave going on, what does that, you see that in your business? Do sales spike? And then conversely, I guess what happens in winter?
Yeah, it's kind of funny. When it's too hot, sales actually dip a little bit because everybody's staying inside. But overall, yes, absolutely, there is seasonality to the business. Now, if a store is not making money in the winter, we as a franchisor are taking a good look at that store and figuring out why. Like, the store should always be profitable. We have such a loyal customer base who are coming to us weekly. This is a treat you can eat literally multiple times a week. So that's the goal. So it is to remove as much seasonality as you can. But obviously, people get more frozen dessert when it's warm outside than when it's cold
Consumers
outside.
now, Neil, we talk about this on the show. They're very focused on ingredients. They're very focused on what's going into their food, sugar and protein. Have you seen a change in what people want in their frozen yogurt?
Yes, and we are trying to stay in the forefront of that. Just January, we launched the world's first kefir soft serve, which is a product I spent over a year, over probably 30 different samples on. Kefir is a different type of probiotic. It's a kefir grain rather than a yogurt culture. But we're going to continue to invest. Our oat milk vertical, every store has 2 oat milk flavors. They don't taste any different than dairy flavors. They're really, really good. We spend a lot of time and money on them. And so we continue to look for what consumer trends are happening and then also want to be early to it. Like with kefir, I think we were a little bit early. There's a few brands that have really penetrated the grocery store model, but kefir is not necessarily as big of a thing in consumers. I think in 2 or 3 years, we're going to have a kefir line of product, and we will be the ones where people have sampled it early and gotten to try it at 16 Handles and know us for that product. And we'll continue kind of to focus on that. But high protein flavors, like you said, we've done keto when keto was a thing. We'll continue to do that. I think there's also a large element of virality that people look for now is they want to take photos of their product, and what's a more photographable product than frozen yogurt? especially the way that we launch flavors. We do a new flavor launch every month on the 16th for 16 handles. And like we've done crazy flavors like a French fry frozen yogurt last summer.
How did that go over?
So it had real Idaho potatoes. We gave it our best shot, but really like the marketing pitch there was there's 16 flavors in every store. We can use a flavor as something that you want to talk about. Not necessarily that you're going to get French fry frozen yogurt, but you're going to try it because you have to. And McDonald's is notorious for their broken, soft serve machine. So we, poked fun and said, well, we've got a broken French fry machine. And now we're pouring out this French fry frozen yogurt. And like those things, people try it, they go home, they might have still gotten cookies and cream or vanilla or, the classic tart, whatever flavor they came in for. But they tried it, they go home, they talk about it at dinner with their family. And now everybody's trying to go to 16 handles and try these flavors.
Your story, Neil, is interesting too. I was reading about it. You're on Wall Street. You're a young guy. I think you work in asset management, right?
Yep.
How and why, Neil, did you say, you know what, forget Wall Street, I'm all in on frozen yogurt? How did that happen?
It's not like necessarily direct connection. Looking back, everything's super obvious and why it went the way it went. At the time, I was such a big customer of 16 handles that the business just made sense. And I needed something hands-on. I just couldn't sit in an office all day. It wasn't my personality. And so when I was exploring the world of food and beverage, the one brand that I always came back to was the place that I would spend my nights or skip dinner to go get 16 handles.
Can I ask, what was the reaction of like Wall Street colleagues? What did they say?
Nobody was stoked for me. Nobody thought it was a brilliant idea. The way that maybe today they'll say like, oh, I told Neil you should go do that. None of them did, but I saw an opportunity and I saw a brand that had a lot more potential than the leadership at the time was willing to kind of invest in it. And so I knew that I could take it to the next level. And now we're, have pretty much doubled in size in terms of store count. We'll be opening our 50th location very soon. Revenue as well as, surged, and especially with the demand we're seeing now, stores up. We just did $1 million in a single week recently, so that was a new marker for us. So yeah, we're really excited about the future. We've got almost 80 stores in the pipeline.
I was going to ask you, like spin ahead, Neil, 5 years from now, how will you sort of gauge and define success? Will it be number of stores? Will it be an IPO? Like, how will you judge it?
It'll be number of stores, but I would rather open half as many $1 million frozen yogurt stores, which was like a marker people didn't believe. But I'd rather open half as many $1 million shops than twice as many $500,000 shops. We end up at the same revenue, but much lower operating costs and much more successful franchisees. And so we've been really focused on choosing the right locations, the right demographics. We really love families. And so we look at family size within territories, median income, because it is an affordable luxury. So we need people to have that disposable income.
You talk about families, Neil. I'm just interested. We talk a lot. One trend that comes up in this show a lot is like younger Americans not drinking as much. I mean, is become a date night for you?
Absolutely.
It has.
It's date night, it's hangout, it's after club sports. So I was just reading this article about the third place that has sort of disappeared, that for a large part of the population was the mall. And there's a lot less malls today than there was. But it was basically saying that the mall helped solve, for a lot of younger people, depression and loneliness. And it was just like a place to go and do and not be consumed by your phone scrolling all day. And we also try and create that community destination where it's somewhere you can always go. It's cheap, it's $10 or something. It's open late at night. It's got this great vibe, great customer service. And you can bring your friends. You could sit down, hang out. We will never build a store with less than 25 seats. We want you to find a seat at 16 handles and hang out. It's not a to-go business. There's obviously, deliveries and to-go, but our loyal customer base is coming, bringing their family, bringing their friends, having this great memory, or bringing a date.
Neil, you brought some frozen yogurt. It looks fantastic. We're all going to dive into that. Thanks for coming on today.
Yeah,
Appreciate
thanks so much.
Stick around. Much less for a trend. That's still to come. Sports pools like March Madness brackets and Super Bowl squares are moving beyond the office and your friends' circles. Splash Sports is taking them and other community-based games digital and now adding prediction markets to a new partnership with Polymarket. Joining us now, we got TJ Ross, co-founder and co-CEO of Splash Sports. TJ, it is good to see you. So maybe start here, TJ, for your viewers who listen, they may not be familiar. Just explain Splash Sports. Walk us through it, TJ. What's the mission? How does it work?
Yeah, Josh, first of all, thanks so much for having me. Splash Sports is the leading platform for peer-to-peer contests. So we've taken the office pool category and we reimagined it for real money contests. And so we have 60,000 people on our platform who we call commissioners who run contests with their friends. And almost 2 million people playing these games. So, you know, anything from a Masters contest to March Madness, a pick'em pool, to what you're going to talk to me about today, which is Survivor, our most popular game.
Well, I do, TJ, I want to understand, too, the business model. Like, how do you guys all make money? Are you taking an administrative fee or platform fee, TJ, for sort of managing all this?
Yeah, so historically, we started by buying two platforms that a lot of people probably know, Office Football Pool and Run Your Pool. And how it used to work was the money would change hands offline. We would charge a $1 fee to every user who was in a contest. And what we've done with Splash is we figured out how to take that money and bring it on platform. So yes, we do take an administrative fee for holding the money as the trusted third party and for administering the contest.
It sounds like a pretty potentially efficient model, TJ, because if you acquire a customer, then hey, that one customer could bring you 50, 100, 500 others.
Absolutely. It's about bringing people together through sports. And, you know, the average contest in year one might have 5 to 10 people, but people stick around, tell their friends, and by year 10, it has 70 people on average. And oftentimes we have pools of hundreds or thousands or tens of thousands of users.
And what is your moat, TJ? I am just curious. Like, let's say a traditional sports book said, you know what, TJ's onto something. This is an opportunity. What would prevent them or somebody else from copying this model, TJ?
It's a great question. So we know because we actually tried to move users from our legacy brands to Splash Sports, and it was incredibly hard. It's just so sticky. Like, imagine getting 10 of your friends to move from one fantasy platform to another. Well, now imagine doing hundreds or thousands of people. It's just not going to happen. And so we have just a really sticky user base that hangs around forever. And so I think it'd be incredibly hard for another platform to come and take our 60,000 commissioners.
You just announced this partnership with Polymarket, TJ. Explain that for us, and why was now the right time to bring sort of prediction markets into the Splash ecosystem?
Yeah, so we got to know the team at Polymarket and Shane specifically. What really resonated with us was he had used our platform for years and was really familiar with these types of contests. But when someone's playing in a Survivor contest or a pick'em pool for the entire season, they're making picks every single week. They're in the app constantly checking the leaderboard, checking the stats. And so we just thought giving users more opportunity to double down on the things they like, or potentially in a Survivor contest where only one person wins at the end of the year, could you hedge your pick towards the end of the season? I had a friend last year who took the Bengals in Week 18, and they were a 4-1 favorite against the Browns, and they ended up losing. And so, being able to offer those opportunities to our users in an integrated way, and in the games they're already playing, we thought was a huge opportunity. And Polymarket was the creator of that category, and the company we have tons of respect for, and we thought they were just the perfect fit to do that.
The regulatory environment, TJ, though, around prediction markets and sports betting, it does continue to sort of evolve. And I'm just curious, how does that uncertainty impact your business in any way?
Yeah, working in a highly regulated industry, it's always something you're paying attention to. And obviously what's happened with prediction markets created a ton of opportunity for us. So, our focus, our differentiator is doing peer-to-peer contests. And with Polymarket, we just launched the largest Survivor contest in the history of Survivor contest, a $21 million guaranteed contest. So, we feel very comfortable in the category that we play in, and we try to focus on bringing that experience to our users in the best way we can, and finding opportunities as the regulatory landscape shifts.
Finally, TJ, I just have to ask you about the World Cup. For a company like yours built around building sports community, what kind of impact does a mega event like that have on you?
I mean, it's incredible. The game last night was electric, and to have an opportunity in the middle of the summer, which is typically a pretty dead time for sports, it's huge for us. It's huge for us to build our following with soccer fans as we start to think about expanding into other categories, and keeps people tuned in all summer long. And then we've also introduced the game of Survivor to soccer. We hosted a $2 million guaranteed Survivor contest for the World Cup, which had tons of people join and had a great reception.
TJ, great to have you on the show today. Thanks for your time.
Thanks so much, Josh.
Stick around. Much press for a trend still to come. Time now for To Watch for the week of July 6th. Markets closed on Friday in observance of the July 4th holiday and will resume normal hours on Monday. But before that, Trump accounts are officially launching on Saturday. The program being backed by companies across corporate America include Chipotle, Comcast, Intel, as well as tech CEO Michael Dell. The program provides a $1,000 investment account for qualifying children born between 2025 and 2028. On the earnings front, Pepsi announcing quarterly results on Thursday. Analysts expecting Q2 to show significant sales growth with net revenue rising almost 6%. Investors will also be listening for any updates to the company's 2026 growth strategy and outlook. And Delta Airlines reporting earnings on Friday. Analysts expecting higher fuel costs to weigh on profits. Revenue is projected to rise a healthy amount, driven by higher ticket prices. That's a wrap on today's show. Thanks for watching.